Types of real estate lenders and when to use them. So there are a ton of different types of lenders out there that you can use, all just depending on the exit strategy you're using for real estate. So whether you're flipping or buying, holding, or doing short-term rentals, long-term rentals, it really just depends. There's so many different lenders out there. I remember when I was new, I always thought, oh, it's just the conventional loan, right? I have to go to Chase in order to get a loan. And there's really so many out there. I'm going to show you a few and what each of them, they're kind of different characteristics that they have and when to use them. So first off is conventional loans, right? Pretty much everyone's familiar with those. Those are your conventional loans, your traditional loans, when you typically need to come down with 20%. There are some, VA loans, FHA loans that you come down with either 0 to very low money down. But these conventional loans are based on your performance as an individual. So what does your W-2 look like? How much income are you bringing in? What is your debt to income? Do you have so many car loans and credit debt and that stuff to where you're not approved for as much? Those are your typical conventional loans. You can either go through the big banks, right? The Wells Fargo, the Chase of the world, or you can go through different credit unions. Obviously, the big banks are going to be a lot more stringent on, they have a box that you have to fit into. And if if your blood type isn't just so, you can they're not very flexible on the types of loans. All the way to your local credit unions. Those are typically more friendly. Their buy box isn't as stringent. They know your local, if you go to a local credit union, they know the neighborhoods and the values and stuff. So they're typically a little bit more flexible in your loans. The next loan type is a hard money lender. So hard money lenders, they typically are for short-term loans. So anything under 12 months, sometimes they're 6 months, sometimes they're 18 months, really just depends on the hard money loan. They are typically for flips or for bridge loans. Sometimes they're used, if you're keeping it as a rental, they're from like the front part when you're renovating something and you just need some cash for the short-term amount to purchase it and renovate it. They are typically your most expensive loan because it's a short-term loan. The shorter the loan, the typically higher the cost it is. It's not necessarily a bad thing. It's just knowing what you're getting yourself into and putting in their points and interest into your calculator before you buy the property so you know what you're getting yourself into. I would say the biggest pitfall when buying your first couple of properties, whether you flip them or rent them, whatever your purchase is, the biggest pitfall is not calculating your holding costs correctly. And a lot of the biggest expense in your holding costs are your lender fees, right? So hard money lenders, they're typically the more expensive route. Maybe they charge a few more points up front. Their junk fees can you've got to really look at their junk fees. And typically their interest rate is a few points higher than everybody else. But hard money loans can be a great source. You just got to put their numbers into your calculator before buying. Another lending type, this is one of my favorites, is a private money lender. Think of an individual that has cash, whether they've got cash in their bank that's not growing very well, or they've got cash in their 401k that they want to utilize maybe in real estate. These are your private money lenders. These can be friends, family, your kids' teacher, or at your local soccer game. They're just individuals. They're not big banks, they're not companies, they're just individuals. And the thing that I like about that is, one, you're helping them, right, make more money. And two, they can typically be a little bit more flexible if you've built that relationship with them on terms. So really those terms, the length of time your loan is, the interest rate, the number of points, all little details, those can typically be a little bit more custom to the individual lender and yourself. We use private money lenders all the time, and it's a mutually beneficial partnership, right? They're getting paid a much higher interest rate than what they would have in a traditional high yield savings account, or even in, if they want to diversify their retirement accounts. Typically that's not invested in real estate. So sometimes they want to diversify what asset types they're in. So that is a great lender to utilize. I highly recommend those. Lastly, the one that I'm going to go over is a DSCR lender. DSCR stands for debt service coverage ratio. This is typically for a longer term loan, like your 15-year, 20-year, 30-year loans. And this has to do with the performance of the asset. So when we talked about conventional loans, we talked about your performance as an individual, right? You've got to make sure your W-2, credit check, all those good things. DSCR loans are more heavy looking at the performance of the asset. So the property, right? How much cash is it bringing in compared to what your principal, interest, taxes, and insurance would be? And whatever that gap is, if it's a big enough gap, they're willing to lend to you. Now, you still need to have a decent credit, right? You still need to have enough cash in the bank. They're still looking at you as an individual, but just less so. They're more focused on, can that property asset perform on its own? We use DSCR loans on pretty much every long-term property we have. They are super easy to work with. You get in with a couple of lenders and they know you really well. They know the area. So highly recommend that. Last and finally are owner finances. Those are gold mines if you can find them. So owner finance loans are when you're purchasing from a seller, someone wants to sell their property to you. And maybe they want mailbox money, right? Maybe they were a landlord with that house and they're just over the tenant, right? But they still want that monthly cash flow coming in. An owner finance option can be a wonderful option for both you and for them. So what this entails is basically the seller becomes the bank. So instead of going down to your local credit union or a DSCR lender, that seller is now your bank. So you're agreeing to buy that property from them and in turn for a loan from them. So you're paying them the monthly principal and interest in the loan versus a bank. This can be super helpful because the terms can get really creative, right? The length of the loan, the interest amount, the points, that's only like scratching the surface of that. You can get really creative on, we have a couple that have interest-free loans because they wanted a certain dollar amount that they wanted to sell the house at. And that didn't make quite enough sense for us, but we told them, hey, if we pay 0% in interest, I can give you that value. And they agreed to that. So it's really a creative way to do that. And both parties end up being happy just based on their needs, individual needs. So those are a few of the general lenders that you can use for real estate. Again, real estate is not a one box fits all. There are tons of lenders out there. There's tons of creative ways you can lend and get financing. So really just have to go and find them and build relationships.